Hey, it's David Krasinski here with DK Home Loans, and today I want to talk about what is a debt-to-income ratio. Now, a debt-to-income ratio in the mortgage industry is different than other industries, and I'm going to walk you through the reasons why. So when we look at a borrower's debt-to-income ratio, we look at a couple different factors, one being what their gross monthly income is. Now, gross monthly income, that is the income that you have before taxes are taken out. So if you're on a salary and you're $120,000 a year, that's $10,000 per month gross income. And the other factor that we look at is a front ratio and a back ratio. A front ratio is your gross income looking at the mortgage payment itself. The back end ratio is the gross income with the mortgage payment and all the other debts that you have that show up on your credit report, like student loans, car payments, credit cards, any installment loans, any child support, alimony, IRS back taxes owed, payments like that. So it doesn't worry about your phone bill and your insurance bill and things like that, or utilities or anything. It's more concerned with what shows up on your credit report. Now, here's a screenshot that we can look at, and this is an actual test file. So no borrower information is on here, but you could see this debt to income ratio is showing right up here, 34 over 43.49. These are just numbers as a function of this test file's information. So we're going to go down here and we're going to say, okay, this borrower is looking at a purchase price of $345 with 3% down with a note rate of 6.298. That puts the total monthly payment at $2384. And we can take a look here and say, okay, what is the payment comprised of? Well, it's principal and interest, homeowner's insurance, property taxes, mortgage insurance, and a homeowner's association. So we're looking at the total payment of $2384 and the borrower's income, which we have here at $7,000 per month. Now, that is the front ratio. So if we take the $2384, that is 34% of $7,000 per month. Okay. Now, the back ratio is the one that most lenders look at when they're looking at the overall debt to income ratio. And how we're going to examine that is we're going to go to this borrower's liabilities. Now, this borrower has a car payment right here for $310 per month, and the borrower also has credit cards of $350 per month. And so when we add those two together, that's $660 or 43.49% of their total gross income. Now, if we're saying that we can have a maximum debt to income ratio of 45% on most conventional loans, then this borrower is almost maxed out. They're almost at the end of how much they could qualify for. So this is just a real simple explanation on how debt to income ratios work. Each different loan program will have maximum debt to income ratio, and it'll also look at things like credit score, other things come into play with that. VA has its own, FHA has its own maximum, conventional loans have their own maximum. There are certain exceptions that you can get if you have 6 months reserves on a conventional loan. So a lot of things that go into it, but as a consensus, if you really want to know, most of conventional loans are maxed out at 45% or 50%, whereas FHA loans can sometimes go up to 57%, and VA is more a residual income calculation. If you have questions on that, reach out to me. Thank you so much.